In 1999, a 34-year-old executive quit Oracle, rented a one-bedroom apartment, and declared war on the entire software industry with 3 words: the end of software. That company became Salesforce, a $41 billion giant. 27 years later, Wall Street has turned those exact 3 words back on Salesforce itself. Revenue just grew 13%. Profit beat estimates by 25%. And the stock lost almost half its value in 12 months. Either the market has broken, or Salesforce is about to be. If you like daily deep dives, subscribe now. March, 1999. Marc Benioff, Parker Harris, Frank Dominguez, and Dave Moellenhoff crowd into a rented one-bedroom apartment at 1449 Montgomery Street, on San Francisco's Telegraph Hill. Benioff had spent 13 years at Oracle. He was a star there. He walked away because he'd seen something the industry hadn't: software didn't need to ship on a disk and take 18 months to install. It could just live on the internet. The competition was Siebel Systems, king of customer software, sold on CD-ROM for millions per license. Benioff didn't out-engineer them. He out-marketed them. He printed the end of software on everything. He hired fake protesters to picket a Siebel conference. It was theatrical, it was petty, and it worked. Because underneath the stunt was a real idea: stop selling software as a product. Start renting it as a service. June, 2004. Salesforce goes public at $11 a share, raising $110 million. By the closing bell on day 1, it's worth more than $1 billion. The model everyone called a toy had just been validated by the public markets. Every subscription app you use today descends from this moment. Here's how Salesforce actually makes money, and you need this to understand everything that follows. Salesforce charges per user, per month. Every salesperson who logs in is a seat. Every seat has a price. If your company hires, Salesforce's revenue grows automatically. The invoice just gets bigger. It's the closest thing enterprise software has ever had to a toll booth on employment itself. And for 25 years, employment kept growing. Salesforce isn't one product anymore. Sales Cloud, the original. Service Cloud. Marketing Cloud. Tableau. MuleSoft. Slack, bought for $28 billion. And Data 360, unifying a company's scattered information. Together they sit inside most of the Fortune 500. That's why remaining performance obligations, business already contracted, stand at $72.4 billion. Salesforce isn't a vendor to these companies. It's plumbing. Now the actual numbers, because they aren't what the stock price suggests. Fiscal 2026, revenue of $41.5 billion, up 10%. Free cash flow of $14.4 billion, up 16%. Read that again. Cash flow grew faster than revenue. This company turns roughly 1 in every $3 of sales into pure cash. Then the most recent quarter, reported in May. Revenue of $11.13 billion, up 13%. An acceleration. Adjusted earnings per share of $3.88 against expectations of $3.12. A 25% beat. Reported earnings per share up 52%. Salesforce called it a record first quarter. By any normal standard, it was. And it's giving the money back. In fiscal 2026, Salesforce returned $14.3 billion to shareholders, $12.7 billion in buybacks, $1.6 billion in dividends. Then the board authorized a $50 billion repurchase program. That's roughly a third of the entire company's market value. Management is saying our own stock is the best asset we can buy. Either conviction or a very expensive mistake. So what is Salesforce betting on? Agentforce. Artificial intelligence agents that don't just suggest, they act. They answer the support ticket, update the record, close the loop, without a human touching it. And it's selling. Annual recurring revenue hit $1.2 billion, up 205% year over year, from $800 million just one quarter earlier. Add Data 360 and the combined figure is close to $3.4 billion. One of the fastest scaling products in enterprise software history. To feed those agents, Salesforce spent about $8 billion acquiring Informatica. Informatica does something unglamorous and essential. It takes an enterprise's fragmented, contradictory data and makes it usable. Benioff put it bluntly. Data and context are the true fuel of Agentforce, and without clean, connected, trusted data there is no intelligence, only hallucination. It also bought Fin for $3.6 billion. Own the data, and you own the agent. Salesforce is running the experiment on itself. Benioff says artificial intelligence is keeping engineering headcount flat. Same people, more output. In June, the company cut 86 roles across Agentforce, MuleSoft and Marketing Cloud, its third round in 9 months. Small numbers in a company of tens of thousands. But the signal is loud. The roles being trimmed are the routine ones. And now the reason the stock is down. Between January and February of 2026, the enterprise software sector lost between $285 billion and $1 trillion of market value. Analysts named it the SaaSpocalypse. It wasn't triggered by bad earnings. Earnings were fine. It was triggered by an idea that agents can now execute the workflow themselves, and software that merely organized that workflow for humans is worth less than we thought. Here's the bear case in one sentence, and it's genuinely elegant. Salesforce charges per human seat. Salesforce now sells agents that reduce the need for human seats. If those agents work, customers need fewer licenses, and the toll booth that grew automatically for 25 years starts running in reverse. Salesforce would be the first company in history to sell its customers the weapon aimed at its own revenue model. Nobody yet knows the exchange rate. The second risk is more immediate. In July 2026, both KeyBank and Bernstein downgraded the stock, arguing Agentforce adoption is slower than the headline numbers suggest. KeyBank cited weak customer feedback directly. The entire bull case requires agent revenue to scale fast enough to offset erosion in the seat base. If Agentforce is being bought by pilot programs rather than deployed at scale, the offset arrives late. And late is the same as never when investors run out of patience. Then the tell inside that record quarter. Salesforce raised full-year guidance to between $45.9 and $46.2 billion, up 11%. Analysts wanted $46.12. The midpoint landed slightly light. In a normal market, a rounding error. In this market, evidence for the prosecution. Proof that growth is decelerating toward the low teens. That's why a 25% earnings beat moved the stock down instead of up. So let's price it. Market capitalization, roughly $156 billion, the stock around 167 in mid-July. Down about 48% in a single year. The all-time closing high was $363.22 in December 2024. And the forward price-to-earnings ratio? Around 11.8. The company that invented the cloud subscription now trades cheaper than the average industrial manufacturer. Here's the arithmetic that makes value investors sit up. $14.4 billion of free cash flow, divided by roughly $156 billion of market value, is a free cash flow yield of about 9%. 9%. From a company still growing double digits, with $72 billion in contracted future business, buying back its own stock. The market is pricing a business in structural decline. The financial statements describe a business that is not. At least, not yet. 52 analysts cover this stock. The average rating is buy. The average 12-month target is $245, roughly 47% above where it trades. Guggenheim called the bear case misaligned with reality. But be careful. A large gap between price and target isn't a discovery. It's a disagreement. Either the analysts are anchored to a broken model, or the market is pricing a catastrophe that isn't coming. Strip everything away and this is a single race. On one side, agent revenue compounding at 200%. On the other, the slow erosion of a seat base built over 25 years. Bulls and bears agree on the facts. Agentforce is growing fast, the seat model faces structural pressure, and $41.5 billion in revenue is real franchise value. They disagree on one thing, whether the new revenue scales before the old revenue cracks. That's the whole investment case. If you want exposure, Salesforce trades on the New York Stock Exchange under the ticker CRM, and it's a member of the Dow Jones Industrial Average. Most broad United States index funds already hold it. You may own some without knowing. For a less concentrated approach, software and technology exchange-traded funds spread the same theme across many names. Because the seat versus agent question isn't unique to Salesforce. It hangs over every subscription software company. There's a symmetry here that's almost too neat. In 1999, Marc Benioff built a company on the promise that the old way of delivering software was finished. He was right, and he got rich being right. In 2026, the market is making the identical argument about the model he built to replace it. The end of software, again. Only this time Salesforce is the incumbent, and it's the one selling the disruption. Maybe that's the smartest position anyone could be in. Maybe it's a slower way to lose. The next 4 quarters will tell us. This video is for education, not investment advice. If it helped, subscribe. A new deep dive drops every day.